Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ENERPAC Tool Group CORP Annual Report. ENERPAC Tool Group Corp offers a diverse range of businesses and services across various industries. The company's key offerings include industrial tools and solutions, hydraulic and mechanical tools, high-force hydraulic and mechanical tools, cylinders, pumps, valves, and bolt tensioners, specialty tools, and other miscellaneous products, tool rentals and services, maintenance and manpower services, heavy lifting technology solutions, branded tools under the ENERPAC, HYDRATIGHT, LARZEP, DTA, the Smart Move, and Simplex brands. The company also operates in various markets, including infrastructure, industrial maintenance, oil and gas, mining, alternative energy, civil construction, and more. The ENERPAC Tool Group Corp stock price has shown mixed results over the past year, with conflicting data indicating both increases and decreases in value. However, a closer look at the company's financial performance and news reveals several key factors that have contributed to its overall trajectory. A strong Q4 2025 earnings report, which included net sales of $617 million and a 13% increase in net earnings, was a major catalyst for the recent stock price surge. The company's optimistic outlook for fiscal 2026 also boosted investor confidence. Additionally, strategic investments, successful integration of acquired businesses, record revenue in a challenging market, and a share repurchase program have all contributed to improved financial health. The launch of new products and expansion of e-commerce business by 32% in fiscal 2025 further demonstrated the company's growth potential. Consistent dividends and institutional investor confidence also provided stability to the stock price. However, an insider stock sale by the president and CEO may have had some impact on market perception. Overall, while the stock has experienced fluctuations, a combination of solid financial performance, strategic growth initiatives, and positive outlook have likely contributed to its overall movements, preventing dramatic downward spirals. The primary drivers of revenue growth or decline can be summarized into three main categories: internal strategies, external market conditions, and neutral factors. Revenue growth is primarily driven by internal strategies such as organic growth in key vertical markets, expansion into emerging markets, customer-driven innovation, digital ecosystem expansion, margin expansion through operational efficiency techniques, pricing actions to offset commodity increases, and the Ascend transformation program. These strategies have contributed to significant revenue growth, with contract assets increasing by 154% from $4,531,000 to $11,759,000. On the other hand, revenue decline is primarily driven by external market conditions such as supply chain issues, economic conditions, customer demand, geopolitical risks, inflationary pressures, and disruptions in global oil markets. These factors have had a significant impact on revenue, with some pages mentioning multiple factors contributing to revenue decline. Neutral factors, which do not significantly impact revenue growth or decline, include foreign exchange rates, commodity raw material prices, and changes in laws and regulations. Net income and profit margins experienced significant fluctuations between 2023, 2024, and 2025. Initially, net income decreased in 2024 due to supply chain issues, inflationary pressures, and global market disruptions. This trend continued into 2025, with further decreases attributed to increased regulatory compliance costs, reduced sales from government embargoes, and decreased demand for oil and gas products. Profit margins also declined during this period, primarily due to higher costs, reduced demand, and inventory charges in 2024. The operating profit margin decreased by 1% between 2023 and 2025, indicating a persistent decline in profitability. The primary drivers of these changes were supply chain disruptions, inflationary pressures, regulatory compliance costs, and reduced customer demand. These factors collectively contributed to the fluctuations in net income and profit margins over the three-year period. The company is generating positive operating cash flow, a clear indication of its financial stability and ability to manage its resources effectively. The data from both page 35 and page 52 confirms this trend, with the company reporting positive operating cash flows in all 3 years. $111,284 in 2025, $81,319 in 2024, and $77,603 in 2023. This consistent performance demonstrates the company's ability to generate sufficient cash from its operations, a crucial factor for long-term success. The company's financial health has undergone significant changes in recent years. Specifically, the debt level and interest expenses have shown notable fluctuations. Initially, it appears that the total long-term debt decreased from $189.5 million in 2024 to $182.2 million in 2025. However, a closer look reveals that the debt level actually increased by 6.7% over this period. This discrepancy highlights the complexity of financial data and the importance of considering multiple perspectives. Regarding interest expenses, there is clear evidence of an increase. Specifically, interest expenses rose by $1 million due to a 10% hike in variable rate debt costs. Furthermore, cash net interest payments increased from $8.8 million in 2025 compared to $12.4 million in 2024. These changes indicate that the company's financial obligations have become more burdensome. Overall, these findings suggest that the company's debt level and interest expenses have undergone significant changes, with a notable increase in both areas. The company's performance varied across different segments and regions. The industrial tools and services segment performed well, although specific metrics were not provided. In terms of geographic regions, the United States stood out with consistently high net sales in 2025, reaching $229,026. This was accompanied by an increase in property, plant, and equipment, net to $26,075. However, some European countries experienced a decline in net sales. The UK saw a slight decrease from $36,290 2024 to $36,933 2025, while Germany's net sales dropped more significantly from $34,700 2024 to $29,532 2025. On the other hand, some regions showed improvement. In the Middle East, Saudi Arabia saw an increase in net sales from $23,113 2024 to $26,699 2025. Similarly, Asia's China and Netherlands reported increases in net sales, reaching $17,658 and $17,525 respectively. Overall, while there were some areas of decline, the company's performance was generally positive, with several regions showing growth. Management is optimistic about the company's outlook and strategy. They aim to drive profitable growth through the Ascend Transformation Program, which focuses on operational excellence, production efficiency, and cost reduction. The long-term goal is to achieve above-market growth in core business, fueled by organic growth strategies and reinvestment in the business. Key areas of focus include growing the service business through increased work scopes and maintenance activity, expanding product business sales through pricing actions and product mix optimization, reducing Ascend charges and incentive compensation expense to boost operating profit management, is confident in the company's liquidity position, stating that it will be sufficient for the foreseeable future. They also believe that their assets remain valuable, with no impairment charges recorded. However, they will continue to monitor potential risks such as industry or economic trends. The company has made significant transactions in the past year, including both acquisitions and divestitures. Notably, it acquired DTA The Smart Move, SA for $26.7 million, with an additional potential earnout of €12 million. On the other hand, the company has also divested certain businesses and product lines, providing environmental indemnities as part of the deal. The company has a history of paying dividends to its shareholders. In fiscal 2025, the dividend payout was $0.04 per share, payable on October 17, 2025. Similarly, in fiscal 2024, the dividend payout was also $0.04 per share, payable on October 18, 2024. These payments indicate that the company has prioritized returning value to its shareholders through dividends rather than buying back shares. Concerns about inventory buildup and supply chain disruption are prevalent throughout the financial summary. Inventory buildup is a significant concern due to oversupply of components, logistics challenges, and agreements with suppliers requiring minimum levels of inventory. This has led to potential excess and obsolete inventory charges. Supply chain disruption risks also exist, including geopolitical and inflationary environments, shortages of components or raw materials, delays in fulfilling orders, and increases in costs. Logistics challenges such as global freight capacity shortages further exacerbate these concerns. That concludes the financial summary for ENERPAC Tool Group CORP. Feel free to comment below, and I will be happy to answer them when possible.